There's a quiet leak happening in a lot of bank accounts right now. And honestly, most people never even notice it. It shows up in overdraft fees, expensive debt, bad car deals, weak investing choices, and getting played by stuff that shouldn't been obvious. The weird part is, the leak isn't some dramatic robbery. It's just the cost of not being taught how money actually works. And that cost is massive. Americans lose about $246 billion a year because of money knowledge gaps. That's not some abstract stat either. That's late fees, interest, bad refinancing choices, missed returns, and scams people could have sidestepped if someone had actually explained the rules. On average, that's around $950 to $1,000 per person every year. Now stretch that across 40 working years, and you're looking at roughly $40,000 gone. But if that same money had been invested and allowed to grow at a modest 8% annually, it could have turned into more than $270,000 by retirement. That's not pocket change. That's a whole different life. And here's the frustrating part, babe. The people and companies that make money from your confusion have absolutely no reason to clear things up for you. Credit card issuers love it when you don't get how interest snowballs. Car dealers love it when you focus on the monthly payment instead of the real cost. Banks love it when your savings sit there earning almost nothing, while they turn around and lend that money out at way higher rates. The financial world is built to reward understanding and punish guessing. Most people never got proper money education anyway. A huge number of adults say school left them unprepared for real-life finances. Only a small slice ever took a personal finance class before graduating. A lot of people grade their own money skills pretty harshly. And objectively, less than half of U.S. adults are considered financially literate. That number has barely budged in years. And the stress, yeah, that's everywhere. 1 in 3 adults regularly feels money stress, and it follows them home, into work, into relationships, into sleep. It's exhausting. And most of the time, it's avoidable. A lot of people say they would have made fewer mistakes if they'd learned this stuff earlier. They say they'd be further ahead. They say they'd feel less stressed. That's the part that gets me, because it means the pain is not some mystery. The knowledge exists. It was just never delivered properly. So that's what we're doing here. Over the next stretch, I'm going to walk you through the money curriculum most people should have gotten years ago. We're talking about where you stand today, how debt really works, how credit actually affects your life, how to build goals and budgets that don't make you miserable, how to save and invest without doing something reckless, and how to make huge decisions like cars and homes without getting financially wrecked. We'll also cover insurance, scams, and taxes so you can protect what you build. Quick disclaimer though, this is education, not personal financial advice. I'm not your advisor. I don't know your exact income, debts, goals, or risk tolerance. What I am giving you is the foundation, the language, the framework, the map. So when you make decisions, they're informed instead of random. And if you stick around for all of this, you're going to know more about money than most people ever do. Not because you're magically smarter, because you stayed awake while everybody else kept winging it. So let's start with the first question. Almost nobody asks honestly. Where are you right now? There's a simple truth here. If you don't know where you started, you won't know where you are. And if you don't know where you are, you definitely won't know where you're headed. That's true in life, and it's painfully true with money. Most people have a fuzzy feeling about their finances. They think things are fine or bad, but they've never translated that into actual numbers. Before you can improve anything, you need a real snapshot, not vibes, facts. There are 3 numbers you should always know: your annual income, your annual expenses, and the difference between the two. I like looking at this yearly instead of monthly, because life doesn't happen neatly in 30-day boxes. Annual insurance premiums, birthdays, travel, repairs, gifts, random one-off costs, surprise bills, those things mess up a monthly view. A yearly view catches the full picture. Start with your net income, meaning what actually lands in your account after taxes and deductions. If you're salaried, multiply your monthly take-home by 12. If your income changes, use your real deposits from the last 12 months. Include everything you actually receive: salary, side income, freelance work, rental income, dividends, interest. All of it. Then total your yearly spending. Use whatever gets you the truth: bank statements, budgeting apps, spreadsheets, whatever. The tool is not the point. Reality is the point. Include the obvious stuff like rent, mortgage, utilities, insurance, phone, internet, and subscriptions. Then include the messy stuff people forget: groceries, dining out, clothes, travel, gas, entertainment, gifts, maintenance, annual fees, and the little online purchases that somehow turn into hundreds of dollars. Now, subtract expenses from income. That number is everything. If it's negative, you're in deficit. You're spending more than you earn. That means you're not just standing still, you're drifting backward. Deficit spending doesn't just block wealth, it actively destroys it. It creates stress, debt, and panic when anything unexpected happens. If it's positive, that's your surplus. That's the money left after life is paid for. And this is the number that matters most, because income pays for your lifestyle, but surplus buys your future. The bigger the gap between what you make and what you spend, the faster you can save, invest, pay down debt, and create options. That's the trap a lot of high earners fall into. Somebody making $200,000 and spending $200,000 is not financially free. Not even close. Meanwhile, somebody making $50,000 and spending $45,000 may actually be in a better position because they're building a margin. The high earner might even be more trapped because the lifestyle got so expensive that walking away from a bad job feels impossible. Those are golden handcuffs, and they're shiny for a reason. Now let's talk about net worth, because this is the real scoreboard. Net worth is everything you own minus everything you owe. Assets minus liabilities. Assets are your savings, investments, retirement accounts, real estate, vehicles, and anything else that has value. Liabilities are your debts and obligations: mortgage, car loan, student loans, credit cards, personal loans, medical debt, all of it. The difference between the two is your net worth. For a lot of people, especially younger adults, that number is negative. That's not a failure, it's just the starting line. What matters is whether it's trending up or down over time. And the reason this matters so much is simple. Income pays your bills, but net worth buys your freedom. Don't confuse the two. A high income with low net worth is just a fancy treadmill. A moderate income with rising net worth is a path out. One more thing before we move on. Your money personality matters way more than people think. How you emotionally relate to money affects how you save, spend, and invest. Some people are naturally cautious and feel better watching balances grow. Some people are natural spenders who love experiences and impulse buys. Some people are fine with risk. Others want safety above everything. None of that is bad, but it does mean different systems work better for different people. If you're impulsive, automation can save you. Move the money before you can spend it. If you avoid financial decisions, schedule regular check-ins so you're forced to face the numbers. If you're too cautious, you may need to push yourself a little more into growth. If you chase returns, like they're a casino hand, you need guardrails. The goal isn't to become somebody else. The goal is to build a system that works with your brain instead of fighting it. Now let's talk about the giant thing that keeps so many people stuck: debt. U.S. credit card debt alone is about $1.27, 7 trillion. That's just credit cards. Not mortgages, not student loans, not car loans, just credit cards. And the average household credit card balance is over $11,500 as of late 2025. At interest rates that are above 22% for balances, that kind of debt can cost more than $2,500 a year in one rare price of tax. One price of tax is not in export selling, but any money is flowing out of ordinary households. And credit card rates can be brutal. They range roughly from around 6% to 36%, depending on your credit and the card. The average new card offer sits around 22%. So if you carry a balance, the card company is making money every month whether you buy anything new or not. Let's make that real. Say you owe $5,000 on a card charging 21% interest. If you only make minimum payments, you could be stuck paying it off for more than 20 years. You'd pay over $7,000 in interest on top of the original amount. That vacation, couch, or random shopping spree, long gone. The debt? Still hanging around like an ex who never got the hint. This is the core thing to understand about debt. It compounds against you. If you don't pay in full, interest gets added to the balance. Then next month, you pay interest on the interest. Same math that builds wealth can also destroy it. It just depends on which direction it's pointed. Now, not all debt is the same. That distinction matters a lot. Good debt is money borrowed for something that can increase your financial position over time. A student loan can be good debt if the degree meaningfully boosts your earning power and the cost makes sense. A mortgage can be good debt if the home is reasonably priced and you're building equity in an asset. A business loan can be good debt if it helps create more income than it costs to borrow. Bad debt is borrowing for things that don't increase your earning power or grow in value. Credit cards carried month to month, oversized car loans, personal loans for lifestyle spending, payday loans. That kind of debt doesn't build anything. It just steals from future you. And the most dangerous debt is often the kind people normalize. Everyone has a car payment. Everyone has credit card debt. Everyone has student loans. When something becomes common, people stop treating it like a warning sign. But common doesn't mean healthy. If you already have debt, you need a plan. There are two main ways to attack it, and both work. The avalanche method is the math-first approach. List every debt from highest interest rate to lowest, make minimum payments on all of them, and throw every extra dollar at the highest rate debt first. Once that's gone, move to the next highest. This saves the most money overall. The snowball method is the motivation-first approach. List debts from smallest balance to largest. Make minimums on everything else, and hammer the smallest debt first. Knock it out, then roll that payment into the next one. This creates quick wins, and for a lot of people, momentum matters. Which one should you choose? The one you'll actually finish. The perfect plan you quit is worse than the slightly less efficient plan you stick to. If you need psychological wins, snowball is great. If you can stay disciplined and want to save the most interest, avalanche wins. Either way, minimum payments forever is not a plan. If you've got credit card debt, balance transfer offers can help. Some cards offer 0% interest for a limited period, usually 12 to 21 months, so you can pay down principal without interest piling up. Just switch the transfer fee, often 3% to 5%, and make sure you can clear it before the promo ends. After that, rates can get ugly fast. Now let's move into credit itself, because credit is one of those things that can quietly shape your entire financial life. Your credit score is a number from 300 to 850 that tries to predict how likely you are to pay borrowed money back. The higher the score, the better you look to lenders, and the better terms you usually get. That matters a lot. Excellent credit can mean better mortgage rates, lower car loan costs, higher approval odds, and access to premium cards. Poor credit can mean worse rates, extra fees, or getting shut out completely. Your score is built from a few pieces. Payment history is the biggest one, about 35%. Do you pay on time? Every time. Missed payments can hurt for years. Late payments, collections, bankruptcies, all of that lands here. Credit utilization is about 30%. That's how much of your available credit you're using. If your card limit is $10,000 and your balance is $5,000, that's 50% utilization, which is too high. Ideally, you want to stay below 30%. and below 10% is even better. Weirdly enough, having high limits and low balances can actually help because it shows you have access to credit without leaning on it. Length of credit history is about 15%. Older is better. That's why you should think twice before closing an old card that doesn't cost you anything. It may be helping your average account age. Credit mix is about 10%. Different kinds of credit, like cards, installment loans, and mortgages, can help show you can handle borrowing responsibly. New credit inquiries are about 10%. Every time you apply for credit, there's a hard inquiry. Too money in a short time can make lenders nervous. And here's what does not affect your score: your income, your job title, your account balance, your age, your race, your gender. The score is about how you've handled borrowed money, not how much money you have sitting around. If your score needs work, there's a pretty direct path. Pay every bill on time. Set up autopay for at least the minimum on everything. Bring down credit card balances. Don't close old accounts unless they cost you money. Don't apply for credit unless you need it. Check your reports for errors and dispute anything wrong. Good credit takes time to build, but one missed payment can hurt fast. Annoying, yes. Manageable, also yes. Now let's talk about credit cards themselves, because they're one of the most useful and dangerous tools in personal finance. Used the right way, credit cards are actually amazing. They help build credit history. They give you fraud protection. They often include purchase protection, travel perks, cashback, points, and other benefits that can effectively discount your spending. Some even come with extended warranties, rental car coverage, airport perks, and travel insurance. If you pay the full balance every month, all of that can come with zero interest. Used the wrong way, they're financial poison. Once you carry a balance, those 20% plus rates kick in, and suddenly the rewards are tiny compared to the interest. The card stops being a tool and starts being a leak. So the rule is simple. If you pay in full every month, credit cards can pay you. If you carry a balance, they make money off your habits. And if you know you can't trust yourself with that, there's no shame in using a debit card instead. You'll give up points and some protections, but you'll also avoid the interest trap. That's not weakness, that's self-awareness. One more warning: stay far away from payday loans. Those things are designed to be traps. The APR can work out to 300% to 800% when annualized. They promise quick money, but they often just create a cycle where one loan gets rolled into another. If you're tempted by one, almost any alternative is better. Selling something, asking family, negotiating a payment plan. Even extensive credit card debt is usually cheaper than payday lending. Now that you know where you stand and how debt works, let's talk about where you're going. Goals matter because without a destination, you can't plan a route. Most people have vague wishes like be comfortable, retire someday, or have enough. That's not really a plan. A goal has to be specific. I want to be rich is a dream. I want $500,000 invested by age 50 is a goal. The second one can be reverse engineered. You can calculate monthly savings, expected returns, and how much time you have. The first one just floats around in the air and never turns into action. Money goals usually fall into 3 buckets. Think emergency fund, a vacation, a car, paying off a debt, or a house down payment. That money needs to stay safe and available. You do not want it dropping 30% right before you need it. Medium-term goals are 5 to 15 years out. Maybe a bigger house, a business, or a child's education. These can tolerate some market exposure because you've got time to recover from ups and downs. Long-term goals are 15 years or more away. Retirement is the big one for most people. That money usually belongs in growth assets like stocks because you've got time on your side. This matters because where your money lives should match when you need it. Money for next year should not be in the stock market. Money for 30 years from now should not be sitting in a savings account doing nothing. For every goal, get specific. What is it? How much will it cost? When do you need it? then work backward. If you want $50,000 in 10 years and you're starting from zero, you can estimate how much you'd need to invest monthly based on your expected return. Now it becomes a plan instead of a wish. Let's slide into budgeting, because I know, people hear that word and immediately want a nap. But budgeting is really just a money plan. It tells you what's coming in, what's going out, and where you want it to go. That's not misery. That's control. A common starting point is the 50-30-20 rule. Roughly 50% of after-tax income goes to needs: housing, utilities, groceries, transportation, insurance, minimum debt payments. About 30% goes to wants: dining out, hobbies, entertainment, vacations, all the fun stuff that makes life feel like life. And 20% goes to your future: savings, investing, extra debt payments. Those numbers are not sacred. They're a starting point. If you live in a pricey area, needs may eat 60%. If you're aggressively attacking debt, future money might need to be 40%. The point is to adjust intentionally, not drift. That's what a budget really does. It turns unconscious spending into conscious choices. Most people have no clue how much goes to subscriptions, restaurants, or random online buying. They just know the account balance looks sad. A budget fixes that. And there's more than one way to do it. Some people love detailed spreadsheets. Some use apps that auto-sort transactions. Some use cash envelopes. Some automate savings and investing, then spend what remains. The best system is the one you'll actually keep using. A perfect setup you abandon in 2 weeks is useless. A simple system you maintain for years can change your life. A few easy wins can also make a real difference without making you miserable. Call your utility company, cell provider, and internet provider and ask for a better rate. Seriously. Mention you're comparing options. A lot of the time, they'd rather lower your bill than lose you. Review subscriptions. People pay for stuff they forgot about all the time. Streaming services, apps, gym memberships, software, boxes, all of it. Cancel what you haven't used recently. Shop insurance every year. Auto, renters, home, whatever you have. Loyalty often gets rewarded with higher prices, not lower ones. Use unit pricing when you shop. Shelf price can be misleading. Price per ounce, pound, or item tells the real story. Buy generic when it makes sense. Store brand staples and medications are often basically the same product with a different label. These sound small, but they stack. Saving $20 here, $30 there, $50 somewhere else turns into real money over a year. That's cash that can actually support your goals instead of disappearing into waste. Now let's talk about the first big financial safety net: your emergency fund. An emergency fund is usually 3 to 6 months of living expenses held in a safe, accessible place. It's for real emergencies: job loss, medical issues, car trouble, house repairs, stuff like that. It is not for vacations, shopping, or I deserve this spending. Why does it matter so much? Because life is rude. People get laid off, cars break, furnaces die, pipes burst. Without a cushion, those events turn into debt and panic. With a cushion, they're just annoying. If your job is stable and your household has more than one income source, 3 months may be enough. If you're self-employed, in a shaky industry, or the only earner, 6 months or more makes more sense. Keep that money in a high-yield savings account. Traditional banks often pay a joke of a rate, around 0.4% on average, while high-yield accounts can pay around 4% or more. On $15,000, that's the difference between about $60 and about $600 a year. Same money, way better return. No reason to let your emergency fund sit there doing basically nothing. Once you have that cushion, everything gets easier. You can take better risks. You can invest without fear. You can negotiate with more confidence. Financial security is not about being flashy. It's about having options. And because life is never just 1 month, let's talk about the 12-month forecast. Most people budget from month to month, which is fine for day-to-day control. But if you want a real picture, you need to see the whole year. That's where the surprise costs live. Annual insurance bills, holiday spending, birthdays, wedding gifts, back-to-school stuff, registration, taxes, vacations, all the little spikes that wreck a monthly plan. When you forecast the year, you stop being surprised by these things. You can set money aside ahead of time. November doesn't have to ambush you. Summer travel doesn't have to blow up your budget. You can smooth out the highs and lows instead of reacting after the fact. The process is simple. Start with your current income and spending, then project month by month. Add in the irregular stuff you know is coming. Look for pressure points. Can you shift money? Cut something? Save earlier? That's how budgeting becomes proactive instead of chaotic. Now let's move into saving versus investing, because they're not the same thing, and mixing them up can create a mess. Saving means putting money somewhere safe and easy to access. Investing means putting money into assets that can grow, but with risk. If you need the money in the next 1 to 5 years, save it. High-yield savings accounts, money market accounts, CDs. These are for preservation and accessibility. If you won't need the money for at least 5 years, investing usually makes sense. Over long stretches, the stock market has historically beaten savings accounts by a lot. The S&P 500, which tracks 500 major U.S. companies, has averaged about 10% annually since it started. Over the last 20 years, that average has been closer to 12%. Over the last 10 years, nearly 16%. Here's the difference that makes. If you save $500 a month in a 4% account for 30 years, you might end up with about $349,000. Not bad. If you invest that same $500 a month in an index fund, averaging 10%, you could end up with about $1.10 million. Same monthly habit, different destination. That's compound growth for you. Small changes in return turn into huge differences over time, and the longer your timeline, the more powerful that becomes. Anyone who invested in the S&P 500 and held for at least 20 years has historically never lost money in any 20-year stretch. Even the weaker stretches still produced positive returns. But in the short term, anything can happen. 1 year can be wild. You can make a lot, lose a lot, or do both in the same market cycle. That's why money you need soon does not belong in stocks. Over time, the market rises because it represents ownership in productive companies. Some businesses fail, others grow, new winners replace old losers, and the index keeps moving forward. So how do you invest in a way that doesn't require a crystal ball? Index funds. An index fund is a mutual fund or ETF that tracks a market index. The most common one is an S&P 500 fund. Buy it, and you instantly own pieces of hundreds of the largest U.S. companies: Apple, Microsoft, Amazon, Google, and a lot more. The alternative is active management, where people try to pick stocks and beat the market. The problem is, over the long run, that rarely works. Maybe some managers beat the index in a given year. Over 5 years, fewer do. Over decades, almost nobody consistently does. And the ones who do are hard to separate from luck. Index funds also tend to be cheap. They don't require huge research teams or constant trading, so the fees stay low. That matters a lot over time. A 1% fee difference on $1 million portfolio is $10,000 a year. That's not a tiny leak. That's a hose. One of the big names in this space is Jack Bogle, who founded Vanguard and helped make index investing available to everyday investors. His idea was simple: don't try to beat the market, own the market. Average returns at low cost can beat most other approaches. You'll often hear about broad funds like VTTX, which gives exposure to the entire U.S. stock market. Thousands of companies, broad ownership. When the economy grows, your money gets to grow with it. So how much should you invest? As much as you can while still covering your needs and building your emergency fund. The more you invest, the faster the goal comes into view. If you need $1 million for retirement, The monthly amount depends heavily on time. With 10 years, around $2,200. Time is the asset people underestimate the most. Start earlier, and the whole game gets easier. That brings us to retirement accounts, because taxes matter a lot here. A 401k is an employer-sponsored retirement account. You usually contribute pre-tax money, which lowers your taxable income today. Money grows tax-free inside the account, and you pay taxes when you withdraw later. For 2026, the contribution limit is $24,500 if you're under 50. If you're 50 or older, you can add another $8,000 in catch-up contributions, for a total of $32,500. If you're age 60 to 63, there's an even bigger catch-up amount that can push the total to $35,750. A lot of employers also match part of your contribution. That's free money. If your company matches 50% of what you put in up to 6% of your salary, and you contribute 6%, they add 3%. That's an immediate 50% return before market growth even enters the chat. You always want enough to get the full match. An IRA is another tax-advantaged account. Traditional IRAs work like 401ks. Pre-tax contributions, tax-deferred growth, taxes later. Roth IRAs are the opposite. You contribute after-tax money. It grows tax-free, and qualified withdrawals in retirement are tax-free. For 2026, IRA contribution limits are $7,500, plus $1,100 in catch-up contributions if you're 50 or older, for a total of $8,600. Traditional versus Roth comes down to taxes now versus traditional player in versus. Plus, no one can find any balance of taxes or budget. If you think your tax rate will be higher in retirement, Roth can make sense. If you expect to be in a lower bracket later, traditional may be better. If you're unsure, splitting between the two can give you flexibility. A simple order of operations works well for most people. First, get your emergency fund started. Even a basic cushion helps. Second, contribute enough to your 401k to get the full employer match. Third, pay off high-interest debt, especially anything above roughly 8%. Fourth, build your emergency fund to 3 to 6 months of expenses. Fifth, max out your Roth IRA if you can. Sixth, increase 401k contributions. Seventh, if you still have money left after all that, use a taxable brokerage account. That's not a law, it's a useful roadmap. Now let's talk risk, because your investments should match your timeline and your temperament. Stocks are higher risk and higher potential return. They can swing hard in the short term, but historically, they've delivered the best long-term growth. Bonds are lower risk and lower return. They're more stable, but they don't usually grow as fast. A popular rule of thumb is to subtract your age from 110, and the result is roughly the percentage of your portfolio that could be in stocks. So at 30, maybe 80% stocks and 20% bonds. At 50, maybe 64-5. At 65, maybe 45-55. It's just a guideline, not a law. What matters most is staying invested. Markets crash. They really do. Since 1975, there have been multiple drops bigger than 40%. During COVID, the market fell more than 30% in a matter of weeks. Every time, people panicked. Every time, the market recovered and went on to new highs. The people who sold locked in losses. The people who held on, or even bought more, came out better. Your emotions are the enemy here. When markets fall, your brain screams, "Get out!" But that instinct is usually wrong. Time in the market beats trying to time the market. The only way to benefit from long-term growth is to stay invested long enough to actually get it. That's why automation is so powerful. Set up automatic contributions. Pull the money from your paycheck before you ever see it. Make investing the default. Then when the market dips, your system keeps buying. No drama, no panic decisions. Just consistency. Now, because people ask about it all the time, let's talk about crypto. Bitcoin and other cryptocurrencies are speculation. When you buy them, you're betting someone will pay more later than you did today. There's no business producing earnings behind it. There's no cash flow. It's sentiment, scarcity, and hype. That doesn't mean nobody has made money. People absolutely have. And people have also lost a fortune. The swings are huge. The rules can change. And there isn't a century of reliable long-term data the way there is with stocks. If you want to speculate with a small amount you can afford to lose completely, that's your call. But don't confuse speculation with investing. And don't put gold money into something that could get cut in half before breakfast. Now let's hit two of the biggest money decisions people make: cars and houses. Transportation is one of the biggest budget drains for most households. It can easily eat 15% to 20% of your income, and it's one of the fastest ways to quietly wreck your finances. The average monthly payment on a new car in 2026 is around $770. More than 20% of buyers are signing up for payments over $1,000 a month. About 22% are taking 84-month loans, which means 7 years of paying for a thing that is losing value the whole time. The average new car loan is nearly $44,000. Here's what that means in real life. If you're paying $750 a month for a car, that's $9,000 a year. Over 6 years, you've paid $54,000. But the car may only be worth $15,000 to $20,000 at the end. That's a huge chunk of value lost to depreciation, and that's before insurance, gas, maintenance, and repairs. Full coverage alone averages over $200 a month. Now imagine doing it differently. Buy a reliable used car for $15,000 cash, or finance it over 3 years at around $300 a month. The difference, say $450 a month, gets invested instead. Over 30 years, at 8% returns, that could grow to more than $670,000. That's the real trade. Every expensive car is you choosing present comfort over future wealth. Not always wrong, but it should be conscious. A good car rule to keep in mind is the 24-10 approach. Put at least 20% down, keep the loan term to 4 years or less, and make sure all car costs together stay under 10% of your monthly income. If the numbers don't work, the car is too expensive. Scale down. And honestly, used is usually smarter. A new car loses a huge chunk of value the second you drive it off the lot. A 3-year-old car has already taken that hit. You get most of the usefulness for way less money. Best case scenario, buy with cash. Save up, drive a modest car. Make payments to yourself into a savings account every month. Then, when it's time to replace the car, you buy the next one outright. No interest, no loan, no monthly payment. That's how wealth builders handle transportation. They don't treat cars like trophies. They treat them like tools. Now for the biggest purchase most people ever make, a house. The rent versus buy debate is way more nuanced than people make it sound. Buying is not automatically better. Renting is not automatically throwing money away. The right answer depends on your numbers, your timeline, and your life. When you buy, you're not just paying the sticker price. There are closing costs, inspections, legal fees, points, and other transaction costs that can add up to 3% to 6% of the home price. On a $500,000 home, that's $15,000 to $30,000 gone right away. Then there are ongoing costs: property taxes, insurance, maintenance, repairs, OAA fees if applicable. A common rule of thumb is 1% of the home's value per year in maintenance. On a $500,000 home, that's $5,000 annually, and some years will be a lot worse when major systems fail. And don't forget opportunity cost. If you put $100,000 into a down payment, that money is no longer invested elsewhere. It can't compound in stocks while it sits in your walls. Renting is simpler. You pay rent, maybe renter's insurance, and some utilities. The landlord handles the big repairs and property, admirable policies to the great power of the country. So let's say you're considering a $400,000 home with a 20% down payment. That's $80,000 upfront, leaving you with a $320,000 mortgage. At 6% interest over 30 years, your principal and interest payment might be around $1,900 a month. Add taxes, insurance, and maintenance, and you could be closer to $2,700 total. Or you could rent something comparable for $2,000 and invest the difference, plus the down payment money. After 10 years, depending on returns in the market, that investing path could leave you with a big pile of money. Meanwhile, the homeowner has some equity, but also paid interest, maintenance, and transaction costs. So when does buying make sense? Usually when you plan to stay a while. If you're under 5 years, renting often wins. If you're staying 7 to 10 years or more, buying often starts to make more sense, especially if the home is reasonably priced and the market supports appreciation. But there's also the emotional side. Owning gives stability. You can customize your space. You're not at the mercy of rent hikes or landlord decisions. For a lot of people, those benefits matter. So don't just copy what your friends did. Run the numbers for your own life. Sometimes renting and investing is the smarter move. Sometimes buying is the better fit. There is no universal answer. Now, let's protect what you're building with insurance. Insurance is basically risk transfer. You pay a premium, and the insurer takes on certain losses if something bad happens. You're swapping a small known cost for protection against a huge unknown cost. The main types most people need are pretty straightforward. Health insurance is non-negotiable. One hospital stay or serious medical event can wipe out savings fast. If your employer offers coverage, that's usually the first place to look. If not, explore marketplace options or whatever legitimate coverage path fits your situation. But have coverage. Auto insurance is required if you drive. At minimum, you need liability coverage, which protects other people if you cause damage. Collision covers your car if you crash. Comprehensive covers stuff like theft, hail, fire, vandalism, and other non-crash damage. Higher deductibles usually mean lower premiums, but more out-of-pocket costs when something happens. Homeowners insurance protects the house and your stuff. If you rent, renter's insurance is cheap and underrated. It can cover your belongings, liability, and more for surprisingly little money. Life insurance matters if someone depends on your income. The simplest option is term life insurance, which covers you for a set period like 10, 20, or 30 years. If you die during that time, your beneficiaries get the payout. The amount depends on how much income needs replacing and for how long. Disability insurance is also huge and often ignored. If you become unable to work because of illness or injury, your ability to earn is your biggest asset, especially when you're younger. Check whether your employer offers it. If not, consider a policy. The general rule with insurance is simple. Protect yourself from losses you couldn't absorb. Don't insure tiny losses you can just pay for. Extended warranties on gadgets, for example, are usually not worth it. Insurance is for preventing financial disaster, not for making every inconvenience disappear. Now let's talk about scams, because this stuff is everywhere and getting slicker. Financial scams cost billions every year, and AI is making fake messages and fake voices more convincing. So the first defense is a healthy amount of skepticism. If something sounds too good to be true, it probably is. Guaranteed high returns? Scam. Urgent secret opportunity? Scam. Random stranger promising easy money? Yep, scam. People still fall for the old classics because the pitch is designed to make you act before you think. Never hand out personal details to someone who contacted you first. Not your social security number, not passwords, not bank info. If your bank supposedly reaches out, hang up and call the number on your card or statement. Real institutions don't mind you verifying them. Be careful with pressure. Scammers want urgency. They want fear. They want greed. They want you to move before your brain wakes up. A legit opportunity can survive a pause. If somebody pushes you to decide right now, that's your sign to slow down. Use strong, unique passwords. Turn on two-factor authentication. Check your credit reports. Freeze your credit if you're not planning to apply for new accounts soon. That way, nobody can open something in your name without extra steps. And emotionally, this matters too. Scammers prey on strong feelings. So if a money message lights you up or freaks you out, pause. Sleep on it. Ask someone smart. Research before you act. Now, taxes. Huge topic, obviously, and I'm not pretending to cover every corner of it here. But a few basics matter a lot. Know your marginal tax rate. That's the rate on your next dollar of income. It's why tax-advantaged accounts matter so much. Contributions to 401s and traditional IRAs can lower taxable income now, which is a real benefit. Use tax-advantaged accounts before taxable ones whenever possible. Get the 401k match. Use an IRA. If you qualify for an HSA, that can be incredibly useful too. These accounts help your money grow with fewer tax drags. But don't let taxes control every decision. People sometimes refuse to sell a bad investment because they don't want to pay capital gains tax. That can be a mistake. Paying tax on gains is still better than staying stuck in a bad position. Keep records. Track contributions, gains, deductions, and important documents. Organized records make tax season way less annoying and reduce the chance of mistakes. And if your situation is complicated, a good accountant can be worth it. So, yeah, we've covered a lot. Where you stand today: debt, credit, budgeting, goals, emergency funds, saving versus investing, retirement accounts, cars, homes, insurance, scams, taxes. But knowing this stuff is only useful if you do something with it. So here's your move for this week. First, calculate your net worth. Add up what you own, subtract what you owe. Get the number. Second, track your income and expenses. Use an app, a spreadsheet, whatever works. Just get honest about where the money goes. Third, set up automatic transfers to a high-yield savings account and start or strengthen your emergency fund. Fourth, if you have a retirement plan at work, check that you're at least getting the full employer match. Fifth, list your debts with balances and interest rates and choose a payoff strategy. Sixth, write down your financial goals with real numbers and dates, then automate toward them. And going forward, review your finances regularly. Quarterly is a great rhythm. Check progress, adjust, keep learning, keep tightening the system. Because that's the real difference between financial literacy and financial success. Action. Just learning this already puts you ahead of most people. Actually using it changes your life. Remember those numbers from the beginning? The average person loses around $1,000 a year from not knowing this stuff. Over a lifetime, that becomes a massive amount of money. But you just spent time closing that gap. If you act on what you learned, the return can be enormous. Wealthy people are not always smarter or luckier. A lot of the time, they're just more intentional. They understand the game, they stop drifting, they build systems that help them win. And now, so do you. If you're early in your journey, you've got time on your side. Use it. Even small amounts become powerful over decades. If you're further along and feel behind, you still have time too, just less of it. So be sharper. Cut the stuff that doesn't help. Max out the accounts that give you tax advantages. Focus on building wealth, not looking rich. The traps are real. The system does push people the wrong way. And yeah, the education should have been better from the start, but now you know. And when knowledge meets action, that's when everything starts changing. You made it to the end, and that already puts you ahead of a lot of people. Take what you learned, use it, and build the financial life you actually want. The simple formula is this: spend less than you make, invest the difference, avoid useless debt, and give time room to work. That's it. It's not glamorous. It's not flashy, but it works. And now, gorgeous, you know how.